In financial economics, risk is defined as the degree of uncertainty regarding the actual return on an investment compared to its expected return. It represents the possibility that the outcome of a financial decision will differ from the anticipated result, potentially leading to a loss of capital. While risk and uncertainty are often used interchangeably in casual conversation, economists distinguish them. Risk refers to situations where the potential outcomes and their probabilities are known, whereas uncertainty, specifically Nietzschean uncertainty, refers to situations where the probabilities are unknown. 1. Measuring risk mathematically. In finance, risk is typically quantified using the standard deviation, sigma, of returns. It measures the volatility, how much the actual returns of an asset swing around its average mean return. The expected return. Before measuring risk, we calculate the expected return E, its P underscore I, probability of outcome I dat R underscore I, return in outcome I. The variance and standard deviation. The variance, sigma squared, measures the dispersion of these returns. The standard deviation is then the square root of the variance. 2. The Great Divide, systematic versus unsystematic risk. Most risks in financial economics fall into two broad categories based on whether they can be removed through diversification. A. Systematic risk, market risk. This is the risk inherent to the entire market or market segment. It is undiversifiable, meaning you cannot eliminate it by simply owning more stocks. Example, a sudden hike in national interest rates by a central bank. Outcome: nearly all asset prices, stocks, bonds, real estate, may drop simultaneously as borrowing costs rise, leading to a market-wide sell-off. Measurement: represented by beta, which measures an asset's sensitivity to market movements. B. Unsystematic risk, idiosyncratic risk. This risk is specific to a single company or industry. Because it is localized, it can be mitigated through diversification, holding a variety of assets. Example: a major product recall at a specific automobile company, e.g., a battery defect. Outcome: that specific company's stock price plummets, but the tech or healthcare sectors remain unaffected. Result of diversification: an investor holding 50 different stocks across 10 sectors would barely feel the impact of one company's failure. 3. Specific types of financial risk. 1. Credit risk, default risk. The danger that a borrower will fail to make required payments on their debt obligations. Example: a corporation issues bonds but suffers a massive revenue drop and cannot pay the interest coupons to bondholders. Outcome: bondholders lose their principal investment. The company may face bankruptcy or a credit rating downgrade, making future borrowing much more expensive. 2. Liquidity risk, the risk that an asset cannot be sold quickly enough to prevent a loss or at all. Example: owning a luxury mansion in a remote area during a housing market crash. Outcome: the owner might be house rich but cash poor. To get cash immediately, they may have to sell the property at a 40% discount because there are no immediate buyers at the fair price. 3. Operational risk, risk resulting from internal failures such as system breakdowns, human error, or fraud. Example: a fat finger trade where a broker accidentally enters an order for 1 million shares instead of 1,000. Outcome: massive immediate financial loss for the firm, potential regulatory fines, and long-term reputational damage. 4. Inflation risk, purchasing power risk. The risk that the value of cash or fixed income returns will be eroded by rising prices. Example: an investor holds a bond paying 3% interest while inflation rises to 7%. Outcome: the investor's real return is -4%. Even though they have more nominal dollars, they can buy fewer goods than when they started. 4. The risk-return trade-off. In an efficient market, risk and return are positively correlated. To achieve a higher expected return, an investor must be willing to accept higher volatility, risk. Summary table: risk types and impacts. Risk type: source, diversifiable. Primary outcome: market, macroeconomy, GDP rates. No. Portfolio volatility. Credit, borrower default. Yes. Total capital loss. Liquidity, market depth, bullish mismatch. No. Fire sale losses. Inflation, monetary policy. No. Loss of purchasing power.